Right. So thank you very much for joining this conversation. We'll have a deep dive into what's happening on valuations front. But maybe before we start, let's start with introductions so people know where you've come from.
Yeah, hi. Maxim, Matias. I started my career working for OpenOcean, first investors and founders of a company called MySQL, then migrated into late-stage secondaries-backed companies like UiPath and Palantir. And now, since 1.5 years, I'm actively writing first checks into AI-native founders, so founders that are building companies ground up through AI.
Will, I'm a lifer in the VC space, been doing this for over a decade, partner at Passion Capital, pre-seed fund investing in fintech and AI. We were the first money into the likes of Monzo, GoCardless, and various other unicorns.
Lifer sounds like a sentence, like you're trapped. Oh, good. Hi, everybody. I'm Lex. I'm a founder of a venture fund called Generative Ventures. I've been doing that for about 2 years. Previously, I was in Wall Street to fintech to crypto to AI. So I've chased the frontier. I'm addicted to that. I started focusing on investing because I'm really interested in the financial systems that underpin a world where AI is the engine of productivity and growth, and I think those are going to be quite different from others. So my focus is really on the economic and financial infrastructure that goes underneath all the fantastic stuff these guys are building.
I'm Edgar. I'm a founding partner at Enzo Ventures. Before that, I created my own company in the deep tech space, and I sold it back in 2020. Before that, I was at Globo since the very beginning, before Series A, as an early employee. So actually, I decided to step into the VC industry. So we are a very pre-seed fund investing in Southern European regions, mostly in Spain, Italy, Portugal, and France. So we are first check in each of those companies. So we've made out from Fund 1 3 investments so far. We are now heading the final close of Fund 2. And yeah, that's that.
So I guess it's me. My mic, can you hear me? Okay. So my name is Agata Nowicka. I'm the managing partner of the Visionaries AI Accelerator. I've been in the ecosystem for the past 12 years. I've built 2 companies, have been a VC, and now I lead basically efforts to accelerate progress of science-driven AI-first ventures. So why don't we start the conversation about valuations, which is a quite interesting, in my opinion, topic, because we are definitely living through some unprecedented valuations. We are seeing definitely unprecedented valuations. When we tend to think about valuations, we normally think about early stage ventures because majority of VCs tend to operate in that space, but we've obviously seen probably here in the audience as well, 40 billion raised by OpenAI at the 300 billion valuations, unprecedented, 500 million by Perplexity, just literally announced 3 days ago at the 14 billion valuation. So my question to you is that, do you believe that those foundational models are going to be able to retain those sort of valuations? Are they overhyped or are they still underhyped? Lex.
Yes, that sustained eye contact, I think, means that it's my question. Yeah. So it's who's got the magic ball, and of course anything else I'll say will be recorded and then proven wrong immediately. It's great about talking in public. I have 3 points on this. I'll forget them probably, but the first one is that the public markets are pretty broken. So we're talking about the private markets here, and if the public markets did their job, then we wouldn't need to have this problem, right? Like, a lot of alpha and value creation is hiding away from being in the public markets and away from the banking system in the way that we have like private credit and stable coins to avoid having to hold money, God forbid, in a bank that pays us nothing on its interest. In the same way, a lot of entrepreneurs are like, the last thing I want to do is go public because that'll strangle my company with extremely spreadsheet-driven investors, no offense to anybody from a private equity firm, without any vision whatsoever. So people are avoiding public markets, it's expensive, and so instead you have now private markets that operate at the scale of public markets, which is, when you look at it on paper, psychotic, right? Where you're getting like 10 to 100x revenue valuations on companies that are at already 10 to 100 billion in value, which is very unusual, but we can point to SoftBank and most of the Middle East sovereign wealth funds, as well as a bunch of others, for being pretty price insensitive in doing it. Why are they doing it? Because the logic goes like this. The biggest companies are 3 trillion each. NVIDIA's 3 trillion, Amazon 3 trillion, not Amazon, Apple, Microsoft. These companies, if they win, they become a multi-trillion-dollar company. So if OpenAI is the category leader for AI, and it's going to replace one of the 5 category leaders, in the markets, it's going to be a multi-trillion-dollar company. So why at all do I care if it's valued 200 billion or 800 billion? I just don't care. I'm going to flip it. And I mean, I'm being mean, but my intuition is that's around the level of intellectual assessment that goes into that investment decision. And these things compound, so people continue to invest in them until they get marked to 3 trillion, and then you go public and you have 2021 again. I'll say one nice thing, which is the winners do compound. And even though there's like a lot of doubt about the foundational model companies, we had stability fall apart and so on. But if you are like OpenAI and you can horizontally sort of take control of the model layer, and you crowd everybody out, at least for some amount of time, you get an arbitrage opportunity to build vertically and own a distribution channel. And this is what they've done. And that's where they're making a ton of money, right? So they're vertically integrated into consumer. Anthropic is vertically integrated into developers, and those are become really sticky, growing businesses that continue to accrue. So even though you're sort of in the beginning investing into non-commercial, horizontal sort of infrastructure assets that seem to be going towards a price point of free, the distribution going up towards the customer is extremely commercial and has paid off. And so I think that's the kind of the silver lining to my comment earlier.
At the same time, I would say we also foresee a transformation going on in the venture capital space for venture capital funds. We've seen.
Don't launch one; it's horrible.
Yes.
Don't do it.
And exactly, I don't want to talk about emerging funds, but exactly who tends to be now in this market win are those established funds. We are seeing A16Z looking to raise 20 billion funds in the coming months. So Will, maybe over to you. How do you think, maybe kind of building on what Lex already said, how do those high valuations, what sort of dynamic do they bring to the kind of early stage fundraising space?
Yeah, I mean, we're investing right at the far end of the market. So a couple of founders have scribbled on a whiteboard, we're game. The valuations there is finger in the air, narrative-driven, story-driven, and we're just really trying to avoid the sticky situation where your story-driven valuation's up here, and then you get to Series A or Series B, and you're raising on metrics, and it's down here, and you've got a big problem. The practical terms, we've seen the average first ticket money, the price we're paying on that is 30% down from COVID hype years. So our third fund that invested most through COVID to our fourth fund that we're investing at the moment, we've seen a little drop off. Part of that is because we're actively avoiding the overhyped AI rounds where people are coming and raising at 20, 30, 40 million post money with no team, no code, no nothing, just an idea and a great name and a desire to go and raise lots of money to hire lots of really good AI engineers. So there's still a very overhyped sector of the market that are trying to carve out their own layer in foundational. They're probably too late.
But would you do like, I don't know, like a $1 billion round into a $10 billion idea?
We don't have a check size for that. Other people will. And some of these rounds are probably designed for the funds that can cut a minimum ticket.
That's another issue that you're highlighting, which is many of the funds just cannot afford those rounds anymore. And we've seen kind of Series A, Series B, or Series even B funds coming early because they can't really afford Series A rounds of those sort of opportunities.
Yeah, I mean, anything where you're ultimately just buying NVIDIA compute. there's a arms race going on there, and you don't want to play in that unless you've got the checkbook of a nation, really.
I would also add kind of like that 1 billion at 10 billion valuation round. That's not really where you make your returns. That's a strategic round that you enter. And to be honest, as we've seen, hype rounds are not translating on a pre-seed level into outlier success. So from our portfolio that we've studied and those of others is a hot round doesn't translate into outlier returns. So that's why we also actively avoid those.
Exactly. When you think about the 20 billion of A16Z, what's the kind of, who can do the quick math? What does it mean? What sort of an outlier exit would they need to have to return that fund?
Well, I mean, collective value, they own 10% exit of, on average, across the entire portfolio. That's 2 trillion of exit value that needs to get delivered. It's crazy.
Exactly. So these are
Not with inflation.
so
Nobody's
maybe,
laughing at my inflation joke. Your purchasing power is eroding. It's sad.
So why don't we come down a little bit exactly to the early stage investing, and Edgar, over to you. You know, what sort of signals therefore are you looking for when it comes to those early stage founders? You know, are traditional, let's say, SaaS valuation metrics, you know, are even relevant for AI startups?
Not really. So at the end, our thesis relies 100% on team. So we are first check. So we are looking for best-in-class people in the region. So basically, we know beforehand that we have to pay like a premium for them, right, to step into the round. So at the end, so we don't focus on quantitative metrics itself, but we are getting like 2 or 3%, 4% of the company, and we figured out the valuation afterwards. So basically, we do it like subjectively, and we talk with the founder, and usually they got diluted like 10, 20% the first round. So with and if they want to raise like 1, 2 million, so you get the final valuation, right? But in our case, that we're looking for outliers, for best-in-class people that have already created a company, have sold a company, or they came out from big tech companies. We know that we have to pay a premium, right? So we are now, for instance, stepping into some companies with valuations 30 million, 40 million, 20 million, even in Spain, Spain is booming right now. So, for instance, Sequoia did their first investment last month in Barcelona, and A16Z did 2 investments so far here in Spain in the last 2-3 months. So I think that the ecosystem itself is changing, and we are seeing like more and more people with ambition, with international mindset. The same is happening in Italy, right? So we know that we have to pay those valuations, especially now in this AI boom, this new AI wave, right? But on top of that, I think that returns can be huge as well, right? So yeah.
So maybe apart from the team, which kind of hasn't changed, that's what you're saying, kind of across the years. Maybe Maxim, what are the other, let's say, I call them levers, are you looking for that might, for maybe founders in the audience, they might consider to focus on to bring that valuation up?
Sure. The way we look at it is fairly simple. So proprietary data, basically distribution and verticalization right now on an application level. So we don't explicitly look at foundation models. That's a different game for a different set of investors. Proprietary data for us means that if a startup has access and is able to generate proprietary data that OpenAI and other companies don't have access to, that's a moat, and that data moat compounds. What matters then on a vertical level is that, let's say you work with banks or you work with legal companies, they give you access into certain problems that previously were not able to be worked on a SaaS level. So you have agentic AI that now conquers entire workflows. It overtakes and creates far more value than we were previously able to evaluate. So, and on top of that, also the distribution model, right? So contract values have changed, and we basically take those 3 components and look at, is our startup able to outpace a vanilla founder? So in our case, an AI native founder, and that's where we can give a premium on a valuation. But that being said, it's a very tough terrain to assess. What is an overhyped round in terms of valuation? How do you truly price this in? But it matters on how deep you, of course, do your due diligence, which often case in pre-seed is a very, very difficult game. So how do you feel those signals that say like an AI native founder or an AI company deserves far more from a valuation standpoint than a classical founder. So this is very, very difficult and sensitive territory.
Yeah, it's definitely interesting. And just a question, maybe to everybody, what sort of dynamic are you seeing when it comes to fundraising, sitting around the table and proposing that valuation? Is it mostly founders that propose kind of high valuation? Because when I moved to the venture capital space, kind of valuations were pretty standard. My point is there was not much you could literally there was not much room to negotiate.
If you're not a big shop nowadays, it's really tough to compete, right, and to set a valuation. So you have to accept the terms, otherwise you are out as a micro or fund, right? So especially nowadays, big names, big shops are getting lower, and they are founding they want to take the whole pre-seed rounds. So it's becoming really, really competitive. So you have to accept the terms.
We have a hype right now in investing into AI companies, but 90% of the companies that we look at, and I don't know how it is for you guys, are true noise. They claim to be AI companies, they claim to be AI native founders, but in reality they're not. So those valuations are absolutely not justified. And when you meet a company that is truly native in that space, you can think twice about giving them a higher premium in terms of valuation. So it is justified. An example is we invested into a company recently where A16Z followed on and Jensen Huang from NVIDIA. When we did a due diligence in that company, we saw 80 agentic AI workflows working with each other, two-man team generating $500,000 ARR, and the company was 5 months old. That's where we are willing to pay a premium, because that founding team is so far ahead compared to the vanilla founder. So there it makes a lot of sense.
Yeah, exactly. So I'm differentiating the best ones, not the standard one. But the best ones, you have to accept the terms. Yeah.
Okay, so I think we've used the word FOMO. I think it's 3 or 4 times
We've also
now.
used the word vanilla founder, which I love.
I like
Plain
that as well.
taste, yeah.
Strawberry founders, pistachio founders.
Yes. So you're saying you don't want to be a vanilla founder these days. So Lex, how would you define FOMO? What are some of the kind of signals that you see around that you would say, okay, this is definitely overhyped?
So our investment niche is a little bit different from others here in the sense that we're focused on AI economic activity, but we care about the financial and economic systems underneath, and in particular around fintech and crypto native approaches to that. For the other guys on the panel, that is probably in the sort of like rubbish bucket that they don't look at. For us, there are people, few of them, who understand both how AI works on a technical level, but then also what are sort of the social and economic and financial flows that might come out of it. If you want to look at big companies that are doing this in the most sort of like OpenAI and Stripe are working closely together. Stripe just spent $1 billion on stable coins. They're charging 4% per transaction, therefore it's not very competitive. But regardless, like sort of Web 2 companies are clicking together to start to solve what does it mean to financialize lots of AI agentic activity, or to mutualize the ownership of GPUs. How do you solve like low utilization of clusters? How do you financialize and own like different products from AI engines and so on and so forth. So we have a very particular sort of personality that we're interested in. And in terms of like rounds, I think there are different reasons for us to invest. Because we're very investment thesis driven, which is probably a bad idea, but regardless how we approach the world, like we'll come across people who really resonate and are trying to build around our investment thesis and agree with us, or we agree with them. And when you find these people, like we're not in a situation where it's like a hot A16Z round and like you get in or not because like you gotta price yourself and squeeze in. It's I mean, it's not like the founder crying for being seen for the first time, but they really start to, they're thankful to meet somebody who is like them.
Who understands what they're building.
Understands. Yeah. And this is also sort of like more contrarian investing, right? In the sense that you're going out of the way into sectors that other people might not find very attractive or don't understand because there's a lot of hair and sort of confusion. And so I really like those deals. And we've made a bunch of investments in teams like that where we came in at a lower valuation than everybody else. Other investors like wired money on a following round before we were able as a small fund to even get in there, and then when we got in there, they were like so excited to have us as advisors and to market us as a fund that, and these aren't, the outcomes for these companies can be very good, so we've had a 10, 20x investment in a token network for machine identity and transactions that has already gone public and is a real outcome, but we were able to get to the founders during a bear market when they were really sad and alone. But we also do participate in rounds that are, we show up to a round, it's almost done, there's a marquee name in it, and the team is fantastic, so we're happy to have a seat at the table, and they think that we'll unlock a little bit of a network somewhere for them where they don't have a network because I'm a prior operator. And so in those cases, we'll try to rush and get into it, and we won't criticize the valuation. Mm-hmm. There are occasionally things that are insane, so especially in crypto AI, you'll see 500 million pre on a nothing, and not even sort of like thinking machines nothing where it's engineered to be strategic. But like literally on a nothing, but there's the money to splash around. And the best we can do is just not touch it.
So you have a very contrarian, obviously, mindset in the ecosystem that literally, no, in my opinion.
This audience is horrible. I hate you guys. It's just awful, awful.
What I'm trying to say, you have a very contrarian mindset, having been in this ecosystem for some time now. Definitely, many VCs move like herds. And maybe real, because you've seen kind of beyond even valuations, we talk about valuations, but beyond potentially things that we've mentioned, what are the other kind of, let's say, elements that you've seen kind of that leads VCs into this kind of FOMO mindset?
I mean, the FOMO mindset is real around you get a good name into a deal and you've suddenly got a bunch of smaller funds and angels and family offices that want to pile in behind it. But that's not what FOMO should be about. It's not about, did I get into the hot deal that got on the front page of whatever newspaper or website or in the right blog and was covered because it had cool founders. Because you look back at history and it's littered with fantastic companies that had to pitch hundreds of funds, couldn't get their pre-seed away, finally got the kind of last door that they turned to before giving up. They got a little bit of money and then they went on to build great success. And so FOMO isn't, for us, it's not about did we get into the hot round or not. We've done deals where we loved the founders, we committed to doing the deal with them, we showed it to all the other VC funds that we talked to on our network. They all said no, don't like it, too much of a long shot, too hard to pull off, and we ended up doing it with a bunch of angels, and we're really happy about that. Because when they do really well, if they do really well, we're going to get great access to the next round to stake build, and we're going to be their best friends on that sense. So FOMO is about missing out on companies that change systems, that change how we spend our money or how we save, and doing population level impact. And it's the ones that in 10 years you turn around and go, why on earth did we pass on that deal because it was a bit too expensive or because the founder was a bit too odd or something like. That's where we should have made the bold leap, not following fast after good names and just assuming they've done their thinking right.
Mm-hmm. So you mentioned, for example, names, like we mentioned A60, then there are plenty of others that are kind of, once they're on the cap table, everybody kind of moves with them or towards those rounds. What are some other kind of elements that you've seen that drive that kind of FOMO?
I mean, the other bit, and I think one where Europe's getting it wrong, is where a lot of value is placed on prior operators or prior founders. In Europe, there's probably an undersupply of prior founders who've had good exits and are going again. And so we give the same kind of premium valuation to prior operators. And we've talked about it. There's a gulf between being a operator who's gone on the Series A to D journey as kind of VP product somewhere. They know what good looks like, they've seen what good feels like, they want to do that for themselves. But if you're a prior founder who's been on the Series A to D journey, you're going to have a wealth more experience to bring to bat. And we just don't have as many of those in Europe as you find in the US, and that's probably where we get a mismatch. We talk to peers at US funds and go, why are you paying that premium? These guys are just operators, they're not ex-founders. Yeah. You shouldn't be paying the premium there. So we're conscious of that, but also there's kind of every great business is not built by second-time founders. You've got to take a leap on people sometimes, and we've had some fantastic outcomes in our portfolio built by first-time founders with no connection to the startup ecosystem at all, no prior kind of, if you were just doing CV filtering on the founders, they'd be nowhere, bottom of the rank, and they can build fantastic businesses. So you've got to really judge the character and how dogged and determined they are to make stuff happen.
Yeah. Now, Lex, you also mentioned already, so we all probably know Mira Markati, the ex-CTO of OpenAI, who recently raised a $2 billion round for her Thinking Machines lab. And apparently, I know from few people, she also negotiated an interesting, based on her profile, and obviously just, I would imagine that's just a very simple deck, or maybe none, or the kind of the absence of that deck. She also negotiated quite aggressive terms when it comes to her retaining control over her company, regardless of that future dilution of the company. So now, Edgar, what, apart from valuation, which is one term on the term sheet, what other kind of terms do you see, or have you seen any change when it comes to those hot deals? What's kind of powerful terms that you see that founders can negotiate?
Yeah, sure. So basically, we've seen like many weird things lastly. So the most common one, I think, it's uncapped saves. That's something that we won't do anymore. So we did it once, and we ended up capitalizing a very high valuation in a company that it's performing incredibly. So beforehand, I think that we know at what price do we need to capitalize. So that's something that we learn out from it. And then we've seen like something really, really interesting going on, which is founders doing like huge amounts of secondaries even before Series A. So that's crazy. I've never seen that. So we are against that because they are not aligned, in the long run of the company. So yeah, those two things mainly, I would say.
So big just jumping in there, big fan of founder secondaries at like Series B+, but it's kind of say, pay off the mortgage, don't buy a boat. I don't want any of the founders in our portfolio to own a boat.
Yes. And Maxim, you have some great experience in secondary, so do you have anything to add?
I encourage it as well, but not pre-Series A. Yeah, I think that's the wrong motivation, and I've gone through this as well, where founders were fixated on actually earning far more than the collective pool of investors and the team. So that's a big red flag.
So we've talked a lot about valuations, about FOMO, but I want to also touch on one other topic. I'm not sure whether it's been already discussed today, but obviously, there is a trend, and I feel that it's been talked about over the past few months more intensively about US firms looking at European companies for kind of, let's say, discounted valuations. Obviously, there have been several American VC funds already operating for years, Sequoia Index and so on, in Europe with their subsidiaries. Now, how, from your perspective or from your experience over the past few months, have you seen, Edgar, you've mentioned, some of the US funds kind of being more aggressive in terms of their origination in the US. Maybe, Maxim, over to you.
Sure. I think they've been present for at least 5 years, the big ones at least. It's a natural evolution for a US fund to come into European territory. It's because they have a competitive advantage compared to many local VCs. They are naturally a magnet that attracts the best talent. They don't need to reestablish themselves. They don't need to build up themselves ground up in order to attract the best talent in Europe possible. So I think this is just a natural evolution. The ecosystem is maturing in Europe. We now understand how to develop these ecosystems in order to increase graduation chances in terms of raising and making sure that startups are actually going to get as close as possible to an exit. So that's where the market is heading naturally. Just like for us European investors, we might be looking at developing countries right now. We see exactly that same string. So I think one issue is that US investors, they are very fond of themselves, knowing that they've been in the game far longer than most of us. And when they enter, they squeeze out local players. And that is oftentimes a big mistake, because we are on European soil, we have knowledge that some US investors might not. And I've just gone through this as well. It does not feel good to be squeezed out. So basically what you need to do is you need to be a step earlier before them. That's where the arbitrage opportunity lies.
Yeah, we like to co-invest with people who have similar sized checkbooks to us, because you get that misalignment between the syndication if you go in at the same stage as someone who's got a fund that's an order of magnitude greater than yours. Yeah. And the other thing we always talk to founders about is a US VC may sound great, but kind of at the firm level, and they may offer lots of connections into the US, but you're really just, when you're raising money, you're optimizing for the next 18 months. So who's going to be your kind of on your board? Who's going to be the partner? Are they boots on the ground in Europe, or are they kind of several time zones away? And do you need that help in the US market now? If yes, go for it. If not, next round. Kind of optimize for the people who are going to help you in the short term, not the people who are fancy names and people kind of get all excited about them being on your cap table. It's just about practical help. How do you build a great business? And one of the terms that's all the rage on LinkedIn at the moment is the seed strapping approach. Mm-hmm. If you raise from these mega funds too early, their big incentive is not for you to build the most efficient lean business, it's for them to deploy the most money that they can and to put bigger tickets into your startup. And sometimes that means more dilution, pushing you harder, leading to failures. And it may not build the largest outcome long term, but it may be about what style of business you want to build as a founder and how you select the funds for that.
I think a lot of entrepreneurs don't understand that that's not a good thing, because like I was a founder and I was like, yeah, put more money into my thing. That's great. But what happens is you just build up liquidation preference, and that's why they're selling secondaries in before Series A, because you've raised 250 million, your business makes 5 million, and you're burning everything down over the next 18 months, and there's nowhere to go. You're not going to sell your company sucks. You can't right your ship. It's your fault. Investors are going to maybe make their money back or half, and you won't. And it's been 8 years. And that I see that over and over and over again, and I may have lived a very similar version to that. So it is not a good thing to be stuffed full of SoftBank money.
Yeah, I mean, FanDuel is basically the case study for what not to do as a founder in terms of end outcomes.
So we've talked a lot about kind of this early stage investing, but many of your portfolio companies are currently at the Series A, Series B stage, and some of those companies kind of originated from a very different era before ChatGPT, where kind of their strategy when it comes to growing company, was very different. That kind of technology and growth roadmap didn't really probably include the kind of potential that we have now with kind of AI-first companies. Now, what do you advise those companies today to do, not to have those valuations slashed, or kind of to kind of find their footing? That's a kind of question, whoever.
I mean, happy to jump in. The challenge that a lot of these companies have is that best-in-class growth at the kind of 10, 20, 30 million ARR level now is hugely faster than it was 3, 4, 5 years ago. So if that's how you built your business, you need to have a kind of harsh look at yourself, understand where the business is, and are you going to be within touching distance of best in class that you can go out and raise at best in class valuations from best in class VCs at that stage. If not, kind of what used to be dirty words but can be really good words like profit come into play. And if you're not kind of default alive as a business, then you're not in control of your future destiny because you've got to go and raise from somebody.
Anyway,
there has also been a taste difference in how investors look at startups right now, at least in my case, to the point in terms of profitability. We believe that what we see happening with AI right now is actually making sure that companies can become leaner than they used to be, which means that it's an assumption you don't need to raise as much capital in order to get to where you want to get to let's say 100 million ARR mark. So investors now also look at this by saying, how far are you actually away from profitability with the best tool possible that you're utilizing right now? So that is a big one as well. And I think the really strong founders that we're seeing right now have exactly that mindset.
So we have only 2 more minutes. So maybe I would like to finish off with a question to all of you. You know, what are we going to see when it comes to valuations over the next, I would say, 2 to 3 years? I think this is the horizon we can imagine right now. You know, there's so much talk about, especially from those foundational model companies, about how close we are to general artificial intelligence that is going to make a completely new level of shifts when it comes to economies and what we can do with AI. What are your thoughts?
I think that we will continue seeing these high valuations, especially because we will see more upside on these companies. So we will see like the first $1 trillion company coming out the next 2 or 3 years, AI company for sure, 100% sure about that. So I think that early stage valuations will go up, 100%. So we have to get used to that for sure. So that's my point.
Lex?
I think we're back in risk-on category, risk-on territory. I think a lot is driven by macro, especially where we invest. And so it feels to me like the next 6 to 12 months are probably quite expensive. I think towards the end of next year, it'll be a bad time for everybody and we'll all be sad. But you know, if the singularity comes from thinking machines, then it won't matter because we'll just be being digested by a giant robot factory into Computronium, and that's fine.
Very true. No, I think kind of high valuations here to stay, but also probably a lot more volatility. We'll probably see our first kind of flame outs of the early AI native darlings. Some of them won't manage to sustain the metrics they need, and valuations will flame out. But also we're going to see some fantastic kind of AI native businesses that was founded kind of post GPT-3. They're going to come through and build huge businesses, and that's just going to happen over the next few years. We're going to keep seeing that scale arrive.
Yeah, I mean, like, look at how pessimistic people got after stability fell apart, and then like 24 months later or less, Windsurf sold for $3 billion, right? So it's like,
We'll see true semi-autonomous organizations in the next couple of years with incredible valuations on top of that, and I think the founders will not accept any investors into it. So it will be just 1 or 2 fundraising rounds, very, very early stage, and that's about it.
So I guess the time will tell what's going to happen, but thank you so much for the conversation. That's all what we have time for today.
Thank you.